Salam. Guten Morgen. Good to see everybody. Welcome, welcome. There's a few chairs left up front. If we have coffee and donuts at the back of the room. Just make yourself comfortable, but let's get started, huh? Hey, is that drum? Yeah, Felipe, you should have arrived earlier. What can I say? Hey, welcome to Forex.Today. Today. Let me remind you that trading is risky. Trading Forex is risky. Trading Forex with leverage is risky. Trading Forex or futures or options, they're all risky. One of the reasons it's risky is that you can't really look at past performance and make your calculations and say, well, I face this much risk in the future. We try to do that. In fact, the government requires that a professional trader does all those calculations to give to a potential investor, and then you have to say, by the way, that is not indicative of future results. So I don't know why I'm required to give you these things, but that's how it goes. But because it's difficult to judge your future risk and your future returns, that is in of itself is risky. You can lose all the money in your account, and it doesn't even need to be your fault. Thank you to the Swiss National Bank, for example. You could just wake up one day, you didn't do anything wrong, but something happened and you've blown up your trading account. It does happen. So you got to be careful. That's true, real risk. So one thing that I like to teach is that you stay small and stay humble. What I mean by that is the way to get rich is not quick. Okay? The secret to success is not more leverage, bigger trades. Right? It might be fast, and if you get it right, for a little while you'll have a lot of money, but eventually you will blow up your trading account, but you'll do it, I don't know. It will be your fault, let's say. So to stay small, stay humble means you're never taking big bets, you're never making big trades, and the way that you find your success is through compounding small profits over larger periods of time. Now remember, reward is a function of risk. So if you put yourself in a situation where you might make a lot of money today, then what you've actually done is put yourself in a situation where you'll probably lose a lot. Do you understand that concept? The only way to make a lot of money is risk a lot of money, and your win-loss ratio probably is not favorable to that formula. Okay? So let's just, like I said, stay small, stay humble, focus on the long term, and then never risk money you cannot afford to lose. Hey, my name is Wayne. I trade currencies. What do you do? Oh, snap, you do too. Right on. So let's meet every day, 7:30 in the morning New York time, which is 2 hours before the equity open, prime time. But it's also approximately London lunch. And it's a great time to get together, review what's happened throughout the day, look at the charts, plan out the New York session, realign the satellites is what I like to say. So 7:30 in the morning here at Forex.Today, Monday through Thursday, and then at fxstreet.com every Friday. Go to Forex.Today, register right in here. We have the summary of the video. So this is yesterday's live trading session. Cool. And then at least a dozen trading ideas, Forex trading ideas every day. And I guess that makes sense since it's at Forex.Today. If you're wondering what's going on in the Forex world today, go to Forex.Today. And thank you to some of the analysts that are posting those trading ideas. They're in this room here, and they've worked with me 3, 4, 5 years, sometimes even longer. So thank you to the analyst team. All right, so let's take a look. Asia was fairly quiet. But then something interesting has been happening in Australia. Interest rates are going up, but not by the RBA, the Reserve Bank of Australia. So there's been a couple of big banks in Australia, Westpac being one, and what is it, Commonwealth Bank of Australia? Is that CBA? Is that right, Aussies? All right, sorry, I guess I should know that. Yeah, so CBA and Westpac, these are pretty big banks, right? Like, they're not mom and pop shops. These are pretty big banks in Ausland. And they're actually moving interest rates up. 20 basis points by Westpac, 15 basis points by CBA. Really? So something's going on there in the world, and an eye should be put on it, right? And some investors are saying that the RBA would then seek to counteract these steps, because remember, the central bank it's their job to manipulate the market to get the interest rate they want. Right? They could do that through open market operations. They can do that by changing the reserve requirement. They can do that by changing the discount rate, so on and so forth. But it is their job to manipulate the market. So some people are saying, well, if the RBA doesn't want that, they can enter the open market, right? They can go into the bond market and lower those interest rates. Okay. And in that case, what's the correlation here? Aussie USD down. Is that because the USD got stronger? No, it's because the Aussie got weaker. Now, what is probably going on is the RBA is probably working with these banks in such a way that they want to raise some interest rates but not other interest rates. Is a mortgage a long-term bond or a short-term bond? Yeah, long-term. It's a 30-year bond probably. Well, in Australia, it's probably 20 years. All right, so that's a long-term bond. Which one is more affected by changes in interest rates? Short-term bonds or long-term bonds? When there's a change in interest rates, or even the expectation of a change in interest rates, which one is more affected? Short-term or long-term? Long-term. And why is that? Oh, good. Lots of people typing here. Type, 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 type. Higher duration, higher... Yeah. Why, Lucas? You just asked the same question, Lucas. Yes. Why? Is a dollar 30 years from now worth the same as a dollar today? Right? Let's change the equation. You're going to loan me, $1 million, and I say, okay, I'll pay your $1 million back in 30 years. Haven't you lost something? In 30 years, you get your $1 million back, but what's happened? Was your $1 million going to sit in cash in a suitcase under your bed? Well, so there's an inflation issue, but there's also an opportunity cost issue. Right. GBPUSD is the time value of money. So you need to discount your future cash flows and come up with a new present value, right? There's a discounting process. And so if interest rates go up, what happens to bond prices? Bond prices fall. And so a 30-year bond versus a 3-month bond, well, it'll have that future cash flow discounting process will happen over much more times because of the time value change. It'll get discounted more and more and more and more and more, you know, through the normal open market process. But it's just, if your 30-year bond is paying 3%, but then interest rates go to 4%, nobody wants to buy your bond if you need to liquidate it. Now, if you hold it all the way through to maturity, there's some other calculations you can do, but nonetheless, the price of your bond will fall. That's a capital loss. Now, do you think your 3-month bond cares very much? I mean, it's going to go through almost like very little discounting, because 3 months from now is not much of a dollar today versus a dollar 3 months from now is virtually the same dollar, right? It won't even change a penny. But 30 years from now, right? Did you guys watch Back to the Future yesterday? Back to the Future 2, remember? October 21st, 2015, that's when Marty McFly goes into the future and he orders a Pepsi and it's $50 or $100 or something like that. Yeah, the Cubs win the series. The Cubs actually lost last night and they're out, right? Yeah. So anyways, so you can see though that time does have value and time does have risk. And so that's where some people say bonds don't have risk, right? You loan the government money. The government's going to pay you back, right? Because they could either print more money or they can raise taxes to get the money they need to pay you back, but they're going to pay you back. Can Ford Motor Company, if they get into trouble, can they raise taxes on their citizens? No. Can Ford Motor Company print more money if they're having problems paying back their bondholders? No. All right, so that's why interest rates are lower on government bonds, because they can raise the money. But you can still lose money because your bond, let's say it's a 30-year bond, and then interest rates go up and up and up and up, the value, the price of that bond that can be resold in the open market falls and falls and falls, because relative to other similar bonds, yours pays a smaller and smaller and smaller yield, so it has to be discounted more and more and more and more, because then lowering the price and then including the yield will get you to what a normal bond, or let's say a current bond of the same risk profile would pay, but you've lost money on the price, right? So it might be $1,000 bond, but you might only be able to sell it for $800. You've lost $200. So that's why bonds are risky. But these things get priced. So maybe the RBA wants to affect one part of the yield curve, but not another. And they see a weak economy, but housing prices going up. So what they want to do is make mortgages more expensive to cool that off, but not cool the entire economy off. And so, hey, good luck, RBA. That means monetary, a policy that expands the money supply is one way to say it, Felipe. Okay. So the question is, what is policy easing? And what that means is that they want to make it easier for people to borrow money, and through so that puts more money into the economy. Okay. The opposite of policy easing would be raising interest rates to make the cost of money higher, and then of course less attractive. See, if your bank account pays no interest or very little interest, there's no reason to keep your money in the bank, right? So you tend to hold it in cash, literally currency. There's no reason to have it in a bank. And maybe you'll spend it because you're like, well, my money's not doing anything, so I might as well buy a TV or something. If interest rates were 7%, you're like, well, why would I hold cash? I could just put it in the bank and earn 7%. Thank you, Jimmy. Thank you, DeBusta, for the, yeah, hey, yeah. The ECB didn't raise interest rates. Sorry I didn't cover that live. So you can get 7% in Indonesia, and that's important because inflation's high there, and you want your money to not lose purchasing power, so you're going to have to earn 7% in your bank account just to offset inflation and keep everything, purchasing power parity and all that kind of stuff. So anyways, 3-year bond, okay, dropped 3 basis points. That means if yield went down, what happened to price? Price went up. It went up because bond traders in Australia, or even just around the world, think that maybe if the RBA wants to go in with policy easing, that means they want to increase the money supply by purchasing bonds in the open market, taking the bond out of the market, demand for bonds goes up, right? And then, of course, now those traders that sold the RBA bonds now have cash, and that goes into their bank account, and now that enters the banking system through fractional reserve process. All right. Now, the question is, does it go from the monetary base into the monetary supply? Well, that's a whole different question. But nonetheless, somebody bought bonds because they think the RBA might come in and buy bonds, so they're front running the RBA. You see what I mean? Bond prices go up, interest rates go down, and all because of what you see in here. And then why would the ASX, the Australian Stock Exchange, go up? Especially if interest rates are going up. Why would the ASX go up? Because more money in the economy should boost consumption, should boost other expenditures. It should lower the value of the Aussie dollar, so then things become cheaper for foreigners, and it should free. What I used to call this is a free money rally. Okay. So yeah, Brazil, they kept interest rates the same at 14.25%. Good job, Brazil. Okay. Retail sales of the UK, yay, yay. Right, core retail sales, good. What should happen to the pound? What should happen to the pound? Should go up. Because that should lead to fuel, right? Or fuel, inflation, sorry. That should fuel inflation eventually, right? And then, of course, what's really the big news of the day is the press conference. We've had the announcement. They're not raising interest rates. No kidding. They're not going to raise interest rates for years. So there's nobody cares about that. Okay, but here's the interesting thing. They got to come out and once again say they are not even close to hitting their goals. Okay? So what we've been talking about for a few weeks is that we want to see more quantitative easing, or right, the increase the amount of bonds they're buying per month. And remember, I said it's going to take them so unbelievably long to do so that you've already given up hope. So if you think they should do it now or by the end of the year, then it's going to be about 6 or 9 months before they actually do it. You're going to think it's so late, it's pointless, and then you'll give up and stop trading it, and at that point, you'll probably do it. Do you guys remember that conversation? Well, this is where they need to come out and say, you know, they might even think about probably not doing it. You see how slow we have to get to that point where they need to admit that they haven't said that they won't do it. But we all know they need to do it now. So that's how far we are from that. They haven't said they won't do it. But it's already been 6 months, and they're not getting almost any decent results. I mean, they're getting some results, but they're not hitting their target, right? So now it's a game of how long can they delay their, the success. So I think that's funny, right? So hey, ECB, increase the rate of quantitative easing. You're not hitting your goals. Well, we haven't not ruled that out. Here we go, game of patience, or stupidity, or whatever it is. Oh, wait. It's not stupid, it's a cultural issue. We drink, we smoke, and then we'll talk and talk and talk. And then we'll drink some more and we'll smoke some more. It is Europe, huh? What to do? So let's do some currency trading. Look at pound yen yesterday. Up to the previous high, which was resistance. Nice little drop. Yay! Uh-oh! Whoa! Happened really fast, too. It's funny how it came up. This was probably a good buy, and then we didn't get the higher high, so then it collapsed on itself, right down to support. And then you'd hope it would go up. No, hit the central pivot point, dropped to the midpoint cycle level daily S1. So now that's a downtrend, right? Oh, high, back up to resistance. And how many people lost money in here, huh? Oy vey. Slaughter. I think this is where the bulls, bears, and pigs, they all lost. If you trade pound yen, feel sorry for you, son. I got 99 problems, but a pip ain't one. Yeah, that's 99 problems right there. Holy smokes. So hopefully if you traded this, at least you bought at the bottom, you bought at support, or you sold at resistance. But anything in here could just be a disaster for, I don't care who you are. So you probably lost money on that, or if you didn't, you probably should have lost money on it, but you just didn't manage your risk properly. But either way, it probably didn't work out that great, and it may not have been your fault. Sometimes that happens. Just don't get yourself in that situation a lot. Okay? Now notice going into the daily chart, one of the, let me get rid of this stupid thing. One of the things we've been talking about recently is catching the 5 EMA, right? Look how we kind of just dipped down, popped right back up, and we're riding the 5 EMA again. Not a high in 3 days, yeah, But what are you going to do, pal, when tomorrow there's a higher high and you're like, man, I guess I should have bought it down here at the 5 EMA? Yeah, regretting it. Well, let's talk about this for a second. What if you traded pound yen and you had a 300 pip stop? Let's just talk about it. Don't get upset. Let's just talk. You're going to have to lower your lot size, right? But Steven says it's close to 200. That's dead. This is a daily chart. That's dead. The 200 EMA represents trend. What's the trend? None. Trend is up, trend is down. Suppose you could argue trend is sideways, but we bought it off a double bottom, and we're making higher highs and higher lows, so I wouldn't worry about that. But if you lowered your lot size a lot and tried to stay with the trade, meaning, you know, what you're probably watching most closely is the 5 and the 21 acting as support, you know, if you could stay above those, you should probably do all right. I mean, the double bottom occurred at 180, okay? 500 pips ago. And here, this is kind of where we are now. I know I have a lot of lines going on. I apologize for that, but you know, you can see that I've drawn the bottom of the trend and the top of the trend. So I have this going up, and as you can see, if I go to a weekly chart, you can see we've already had all of this planned out. So wouldn't it be nice if you could lower your lot size and stay in the trend? Now, you don't want to lose a fortune on the trade, but you should recognize that this pound yen has a lot of volatility and a higher average daily range, and that your normal 30 pip stop is, you know, a shake of a lamb's tail. It's almost pointless. Right? Have you ever been in a good trade on the pound yen? Lost 50 pips, but and then it just flipped and goes? I mean, just, so why don't you try lowering your lot size a lot, dramatically, and then try to stay in the trade and just see how you do. Well, it's funny, you bought it at 49. Why wouldn't you buy it at 50? Yeah, I guess it just moved in your favor at that moment. All right, so Aussie. Do you think the RBA is going to come in and cut interest rates? I don't see that. Remember, I don't guess. I don't like guessing. So, I don't know. Is it on the radar that they're going to come in and weaken the Aussie more? I don't think so, right? That's just dumb talk. Just because you read it somewhere doesn't mean it's worth anything. So if you're going to play it bearish, it's fine, because look at the market on this 1 hour chart. It's bearish, right? I mean, 21 below the 55, price lower than this resistance. We're not making higher highs. We made the we made the lower low, right? That's pretty clear, right? So on a day chart, you'd have it set up like this. It's not the world's fastest downtrend, but it's not an uptrend. Okay? Right? There's nothing that says bullish here. So if you're going to trade it, just trade it. Here's the 4-hour chart. Once again, it doesn't seem bullish. But I wouldn't trade it just because I thought, you know, the RBA was going to come in. Oh, they have to come in now. And no, they don't have to do anything. So I don't trade gossip per se. Okay. So we are still at a support area. We got to be careful of that. But this move that we had just recently was a dip below, right? So it'll be interesting to see what happens. You can see not everyone was on the clue train on that one because it came back 786. But, you know, at a small level, you know, it's still a lower high. If we pop back into this range, you know, let's say break back above this orange line, then we go neutral again. If you are a bull, is 7200 support? Okay. Yeah, psych level. This old gray area, purple area, whatever it looks like to you, it does go back a long time, and it is important. So you could play that. It's also a 382 of the macro move here, of this move. Okay, we're on a 382 of the big move. Going back to the 15-minute chart, we're on the 382 of the more micro move, the 15-minute, not the daily, right? So we have a 382 clustered on top of a 382. If you're a bull, is this attractive? Yeah. Okay, you got a lot in play. And what does the 15-minute say? It says if it goes up soon, it's going to go up for 2 hours. So that's your day trade. Okay? So it just depends on, or not your day trade, that'll just get you to what, the New York Open. Okay? But this would be a buy. I'm just kind of putting that out there. If you wanted to be a bull. Now it's still aggressive because we're not in a uptrend, right? So for example, I guess we'll use this one. For example, what is best is when you get, you know what, maybe I should go to a chart. We'll do it this way. Can you see the disclaimer, the Forex.Today disclaimer? I think you can. What I like to do, what I like to trade is something like high, low, high, right? This is what I want to do all day, every day. And there are days like that. Okay? But that's not the market we're in, even if you're a bull, right? Let's go back to the 15. Looks different, doesn't it? That is good. That is not the same. So you just make sure you recognize that if you're a bear, you're looking at it this way. If you're a bull, you're looking at it this way. And nobody really knows who's going to win that match. Okay? Okay? But it is support. There is support. There is resistance. You can do either way. This is what I had set up yesterday. Okay, and I think I said I don't really care if it goes off the 382 or 618. If I'm a bull, I'm going to get ready to buy it if I get a reversal pattern somewhere at either the 382, the 50% or 618, but I don't care which one because it's not my call. I'm not the one going to reverse the market. I'm just simply looking for the market to reverse. And then what's the next step? It's only going to go up a few hundred pips, and then that's where I'm going to take profit, and I think that's where the bears are going to sell. Easy stuff, right? So we talked about waiting for the oscillator to come back around and all these different things. So according to this, there's a reasonable probability of being long today, tomorrow, or Monday, let's say. Okay? So, which one is it going to be? I don't know. Could it even be all three? I've had that. It doesn't happen that often, but you can try it all three times and lose it each time. That's when you get it wrong, right? But what if it bounced here at 72, because the psych level is 72, and then did this? Then the bulls won. Okay? See what I mean? So you could play it ultra conservative and just let it break one way or the other, or you can prepare to buy it now. You have a 3A2 on top of a 3A2. You have at least two, you have concurrency at least in two different time frames. And if you're wrong, you're not interested in trying again until what? You get a reversal pattern down here around 50%. But even that we were thinking was less likely because we're eyeballing 618. So if it doesn't go up here, take a walk. Because it's going to be a while, isn't it? Before we get a chance to check it out down here. But that's the important part of having a trade plan. You do your analysis, and you have a plan to know when you believe you're right, but you should also have a plan to know when you're wrong. Take the small loss and stop trying. When was the last time you had a bad trading day where you had 4 small losses in a row that actually added up to a pretty big sum? How long has it been? Right? Because 3 or 4 small losses in a tend to add up to be a big loss. So you should know when you're wrong and then stop. Well, so Jim says shorting euro dollar, and I've seen this where people lose sight of the two components of trading. One is fundamental analysis, and the other one is technical analysis. And sometimes traders, when I say, look, I'm bearish euro dollar and there's nothing that can change. You're right? Okay, fine. So I'm bearish. Let's say, let's pull up euro USD. All right, I'm bearish. And I only sell green candles, right? These are the messages that you remember. But then I find traders that are like selling rallies. What? And you're like, well, Wayne, you know, fundamentally this has to go down. I'm like, yeah, it doesn't have to go down today, right? And they're like, yeah, but green candles, it's going up. I'm selling it. And I'm like, whoa, 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 girlfriend. You sell green candles in a downtrend. You don't sell green candles in an uptrend. You're supposed to wait for the trend to be in the direction of your fundamental bias and then sell rallies in a falling market. I never said sell rallies in a rising market. Never, ever, ever have I said that. Whatever time frame you're trading, Jimmy. Let's say it's falling on a 4 hour, falling on a 1 hour, you know, I'm going to wait. I'm not going to sell because, you know, if a 15-minute chart says up, it says up for 2 hours. Okay? So, you know, I want to sell these types of things. And that's what you do all day, every day. This type of stuff here, taking candy from a baby. Now, I could lose money because let's say the market decided it wants to reverse, but the only way I can lose money is if the entire euro dollar market reverses. Just decides to go up, like the pound yen. Remember I showed you the pound yen right at the beginning? It went up, then it made a lower low, and then it went all the way back up again. And that's where I'm like, bulls would have given up to become bears, and then they sold the retracements, and then they lost money being bearish, right? There have been days, and in particular, the beast. This is why I call the pound yen the beast. I also call it the widowmaker. It's also probably the most profitable currency pair I've ever traded, but it can also destroy you. You know, so it's a very interesting pair where you can get that, where a higher high is followed up by a lower low, which is followed up by a higher high, and that's no proper technical pattern at all, and you lose money either way. But this type of stuff, Euro USD, trading it down, does that fit my fundamental bias? Yes. If it was the reverse, if we were in a progressive, you know, uptrend, a series of higher highs and higher lows, and I'm a bear, does that fit my fundamental bias? No. Now, I can short-term long it all I want, but it doesn't, I don't have to. Right? So James says that's the tough one, the bias, right? But what it does, and this is why I say it doesn't matter if you're right or wrong, you just have one. It will keep you out of poor trades because you're taking half the possibility of losing away. If you just trade in the same direction, let's say, the worst thing that can happen to you is you might go 2 or 3 or 4 days without getting a trade set up because you're wrong. You want to sell it, but the stupid thing keeps going up. But that's a good thing. You see what I mean? You're like, I hope it reverses here at resistance. I hope it reverses here at resistance. Goes up to resistance, doesn't reverse, and you're like, man, it's another 100 pips up to the next level of resistance. This might take another day before I get a chance to maybe sell it again. Well, good. That's what it's supposed to do. Or a week. Yes. A week with you not losing money is a good week. I don't care who you are. No. Well, how could you lose by not trading? Now, you might have been selling a rally, which is a losing strategy. That's what I'm trying to say. You don't sell rallies. So how about this? Like, was it Thomas Edison that said, you know, he only found 10,000 ways to not make a light bulb? Right? You've learned something. Make sure you know it. I mean, seriously, write it down, make a poem out of it. Write a poem in iambic pentameter about, counter trend trading or something. I don't know. Do whatever it takes. Paint. Paint pictures of a downtrend, right? I don't know. If you're a bear, you sell rallies in a downtrend. If it's an uptrend, don't do anything. How to know it's a rally? Let me show you a rally. That's a rally. That's an uptrend. That's it. If you're a bear, don't do anything. See? That's you not trading. You almost traded here, you almost traded here, you almost traded here. But you never got your trade set up. So James is now saying, well, then when do you trade? Okay. Let me clear this out for a second. And let's do it this way. Okay, do I sell that? Yeah, there's no reversal pattern. Okay? Do you sell that? No. No reversal pattern. Could you sell that? Yeah, maybe. If you're unbelievably aggressive. It's just a double top. But it's better than a higher high. You don't sell higher highs. But that could work out as a double top. Okay? Do you sell that? Fire for effect. That's where you unload everything you have. Just destroy this. See? Lower low, lower high. Right? I think that's what they teach you in artillery school in the Army. When you get the call fire for effect, if one shell will do, drop 10. Right? If one artillery shell will take out the target, drop 10. Kill it 10 times. Words like that's overkill. Yeah, but you're not going to miss. Okay? So James, what you're looking for, if you're fundamentally bearish, but the market is making higher highs and higher lows, is I prefer this one a million times more than I prefer this one. And before any of this can occur, you have to identify the resistance ahead of time. Okay? I'm not necessarily even looking for the pattern. The first important thing is support and resistance, right? S and R. That is the most important thing. So if you're a bear, you want to sell a reversal pattern. Right? If you're a bear in a bullish market, you want to sell a reversal pattern at predefined resistance. And this is why I keep training you on, if you're a bear, identify the 2 levels of resistance, 2 or 3 levels of resistance in which you might consider selling. I'm trying to drill that into you. Okay? So the first thing you need to do, you already know you're a bear, fundamentally. So the next thing is, where's the resistance? And third thing, let me redo this. 1, your bias. Okay? You could, especially in the beginning of your career, only trade your bias. That means this uptrend, you would just completely ignore. 2, find support or resistance. If you're a bull, you want support. If you're a bear, you want resistance. Okay? And then 3, you want your reversal patterns, your RPAT. Okay? And things like double top, lower low, lower high, that's beautiful. That's got to be my favorite pattern of all time. And that's it. Everything else is nonsense. Okay? Adding more indicators and more moving averages and all these other things, they're fine if they help you do these 3 things. So a lot of people will say, well, I did it because of the MACD. Oh, I did it because of this, ADX. I did it this, but no. You use the technical indicators to help you identify 1, 2, and 3. If you're using your indicators because your ADX tells you it's bearish, that's nonsense. Oh, the ADX told me to sell it. Oh, the CCI told me to sell it. No, that's just dumb. You're fooling yourself. Because it's not going to work on the long run because you don't get it. So even if it's been working for you on the short run, don't worry, the market conditions will change and you'll keep doing what you're doing, what worked in the past, but it won't work in the future, and it'll stop working, and then you'll stop listening to it. So it's all nonsense. All your technical indicators should be used to tell you, on your long-term charts, what is your bias? On your medium and short, right? Let's say medium-term charts, you identify support and resistance. And on your short-term charts, you're looking for reversal patterns. So if you're technically let's say long-term technicals, let's say, the daily chart tells you you're a bear on euro dollar. Sell at resistance. Well, where's resistance? Well, let's mark that up. And when do you sell? When you have green candles at resistance, you sell. Like the one I just showed you. I told you this is the one I sell all day, every day. It's like taking money from a baby. Give me those pips, you little brat. Boom. It should be easy. Just, right? Taking money from an ATM machine is more difficult. Because it's a falling market, right? It's a falling market with fundamentals that say that this currency pair should weaken. Okay? If this was going up, I wouldn't do anything. If I'm fundamentally or technically, whatever you use, on the long term is what you need to focus on. If you're a long-term bear and the market's rising today and yesterday, and just don't trade, and that's where you could go. Like I said, the worst thing that could happen to you is you go 3 or 4 or 5 days without trading. Maybe 2 weeks without getting a trade set up. If you're a bear and price is rising, all you're looking for is hardcore resistance and then a reversal pattern there on a small time frame. But you may never get it. Why? It's going up. You're not going to get it until the whole entire market reverses. Think of it. You got to squeeze a couple $100 billion out of the market today. Think of it that way. Wow, I'd really like to sell this, but I'd have to squeeze a couple $100 billion out of the market today. It's a $5 trillion market. I'm not joking. About in the next couple of hours, we got to get a couple of $100 billion out of the euro before I can sell it. Oh, it will happen, just not today or not right now. I mean, your job is to observe that it's happened. And this is one of the things I keep teaching you guys, right? Let's go back to the chart here. Okay. This double top, why did that occur? lots of bulls took profit here, but not everybody. And there wasn't enough to get a higher high, so these guys realize, and they get out. Now, why do they realize? Well, here's the interesting thing. If you know your oscillators were diverging at this point. Why did they diverge? Because the bulls took profit here. It's another way of saying, the market came down, but nobody's selling. So then, because of that, you're going to get divergence on your oscillators. So then it comes up and double tops again, but this time there's a lot less bulls. And these bulls are going to now not get the higher high because they're not attracting more money because half the market got out. So now they get out, and guess what? Some bears get in, knock through some stops, right? And now this is where bears actually sell. This is the first wave of bulls getting out, bull out. This is the second waves of bulls out. And this is the third wave of bear in. These are both BLs, and that's a BR. So you got to wait for the bears to get in, guys, if you're a bear. And it could take several $100 billion to do it. And I don't think your account's that big. Not yet. Yes, James says, if you do the math on whatever indicator you're using, it will diverge. That's why we have it there. That's why it's important to know what your indicators are telling you. I don't even need the indicator because I know the math. I can just look at the chart and know, well, we're going to have divergence there. So anyways, there's the free money, guys. That's all I can do for you. And I'm not feeling good still. Still a little less perfect. Have you ever had 15 hours worth of sleep and you wake up and you're tired? Yeah, that's been the last 2 days for me. Okay, 1250 is going to be a psych level. And then 12, right? Where's the pivot? 33, and then 12. I have to stand up to see my other Euro USD chart because it's so far away. Hang on. Let me check out the monthlies. We have a monthly at just under 112. It's 111.95. Can anybody confirm that? Monthly pivot. The next one is basically 111. It's 110.98. So there's a monthly pivot at 112, and there's another one at 111. Yeah, we're on something now. But all right. And a crazy counter trend trader would buy it off that. It's a weekly S2, as you can see, no duh. But that's not my style of trading. And the monthly pivot, so yeah, but that's not my style of trading, is it? I'm a portfolio style trader. And what was I telling you when Euro USD was going up? Design a portfolio of being short Euro USD. One trade at a time, right? Right? You see, for me, waiting for a news event like this and then counter trend trading it is a very difficult, hard-working job. It's like digging ditches for a living. You can do it, but it's hard work. Jim R says, when did you decide to take profit? On what kind of trade? So what time frame did you set up the strategy? Hourly chart or 2 hour? Or hourly chart or 4 hour? All right. So one way is, you know, when your stop is, your stop would be in here. So you're most vulnerable on the first wave. Okay. But if you had a process like this, then you can then move your stop here. Okay, and then what would happen? Then you move your stop here. Okay. If you're a rules-based trader where you need to know exactly or precisely, because I have some other tricks so often. Like, you may have heard from me over the years that you always take profit at the weekly S2 or weekly R2. Always. I used to almost be famous for that. Always. That's why I have them on my charts. So that this wick that you see where we were talking about counter trend trading, why I don't like to do it, a lot of it is just traders taking profit. So think about the guy that shorted earlier today and had a reasonably close stop loss and was basically hero or zero, and then all of a sudden this thing drops 100 pips all the way down to the weekly S2 and he gets out. That's the good trade. The bad trade is someone counter trend trading it, in my opinion. I do counter trend trade in very specific circumstances, but don't need to do that one. Going to the rules-based one, use this as a guide and see how you feel about it. I always forget this one. Indicators. Use your PSAR. Okay. And it's basically the same as I just told you. Your stop is right here. So 114. Okay. And this is a good one because the math is moving your stop based on volatility. And it looks like it's a million miles away, right? It's 150 pips away. But the only reason it's 150 pips away is the market's moving. Okay? The market is moving. So you want to leave it. When the market stops moving, meaning when it starts to consolidate, then it will move your stop closer and closer and closer, locking in profit. But it won't lock in profit until you lose the volatility. Okay? So you can play around with that. Okay? So, peace on earth. May the pips be with you. May your profits be above average. Tomorrow I will be at FXStreet.com. I'll upload a recording of this video if you want to watch it again and review a part of it. It will be available on Forex.Today. Yeah, it takes about an hour for me to go through that process for you, but I'll do it. You're my sweet baby. Cheers.